welcome to episode 6 of the Energetic Incorporated podcast. I'm Kevin Bambro, and this week I'll be chatting with Tavi Costa of Crescat Capital. We'll be chatting about the global macro, gold, silver, and of course, tariffs and trade. Hope you enjoy. Please like and subscribe if you do. Thank you.
I grew up in Brazil. So my dad was an entrepreneur and of a small business that basically went bankrupt. So I actually had that part of it in my background. And then I tried to help him to sort of start a new business. And he became a farmer after that. So again, very related to the commodity side. And after he's got his foot in the ground, I started playing tennis actually to try to get a better life, and then eventually got recruited, moved to the US, worked in a bunch of different businesses and all sorts of things, and specifically even one of a logistic company in Brazil that I did work for a long time. Never got paid a penny out of that actually. I was just doing it because I wanted the experience, and was really into finance. I was reading 3, 4, 5 newspapers a day, and I read more newspapers than my college books, and start learning a bunch of things. And once I got into working with Crescat, I feel like I've had several jobs at the firm itself. I started as a marketing person, of which I would do all the marketing things for them, and then after 5, 6 p.m., the other analyst would leave. I would take his spot and get into the Bloomberg terminal, deconstructed the entire model that we had, and start to build other things and suggesting ideas and so forth. Then I became sort of an analyst from there. Started working on a theme back in 2011, 2012, about China, that sort of grew to become our biggest theme in the funds. That was basically our short theme on China. We thought China was about to hit a kind of a Lehman Brothers moment, and that became a whole thing. You know, I was very involved in putting that trade together, and it really got around because not a lot of people were talking about China at that time. Then Kyle Bass came in, and other folks started to share their views, which were very similar. We got in touch with some of those money managers at that time, which was a great experience, and made some money on that whole idea, and which was great. It was less of maybe 3 or 4 years on that front. We're short Sunak, Evergrande, all sorts of things, and then in 2018. After that market crash and so forth, I started getting my understanding of the commodity space, and realized how commodities have lagged for so long. And as a contrarian, I started to just trying to understand, get my arms around why commodities, and what could be the thematic idea here, and learn after research, start doing more about the CapEx world of how there are cycles of capital spending across the natural resource industries. And in 2019 or so, got very bullish gold and so forth. And that was the times when Real Vision was starting and so forth. And it was my first interview, actually. I did an interview there and explained my views about gold and so forth. And then later on, we decided to launch a fund about mining, and mostly because mining, the duration of mining takes longer than the duration of other resources. And so we got into mining, then partnered with Quentin Henney. You probably know who he is. And he's a geologist. People that invest in exploration companies know him very well. And learn a few stats about the business regarding, most of the billionaires in the industry made their money in the exploration side. We decided to open a launch a fund that would invest mostly in sort of a hybrid venture capital approach in the mining industry, but mostly in exploration. That kind of took off from there, especially because we made a lot of money for us, not a lot of money for large hedge funds, but on a trade that we were short before the whole COVID thing collapsed. And that raised a lot of liquidity at the time. Naturally, we just just brought that capital back into the mining space, and that we did very well. And then let's see, 2021, 2022 came along, and one of the largest silver mines in the world went for sale. Silver was trading at $15 an ounce, and we did a leverage buyout, 80% debt, 20% equity, purchased that. And now we own what is currently the fourth largest silver mine in the world. That's another thing that I do on the side as well. So working on...
You own that in the fund?
I own that in the fund, but also the partners own, and we control a bit over 30% of the company now, and put one of our partners as a CEO of the company. And and then now we use that vehicle as well, which is a cash flowing vehicle, to acquire other assets as well within that company itself. And it's been I'm actually working on other side deals to acquire other mining companies as well. And as I believe this we're entering a golden age of mining, and so I just I'm
Completely agree with you.
Yeah. I mean,
it's funny. We have, in some ways, we have a very similar backgrounds. So my father was an engineer, but I come from a long line of sort of salt of the earth construction guys. Like my great grandfather and whatever, my grandfather, they were builders, right? Building homes and buildings, office buildings and stuff like that. But they were never stock market guys, Brokers was a dirty word in my family when I was growing up. My dad used to refer to stockbrokers as being used stock salesmen, kind of like a used car salesman. Like this idea that they're just not that scrupulous, and that we're well aware. I guess I sort of was raised with this belief in the boom bust cycle, and about just especially being a Canadian with the Vancouver scene.
Yeah.
Stock promotes, and, most of these companies don't do anything, especially on the exploration side, with only, like, it's funny, you mentioned that these billionaires, there's a lot of mining billionaires that did really well because of exploration, but there's also so many companies out there that drill and accomplish nothing, right? And it's about getting on the right, having the right understanding, having a geologist that's, I guess, a little bit of lucky and a little bit and a lot of skill. You look around the world, and a lot of the biggest deposits and great deposits are ones that were easy to find because they outcropped and there wasn't a lot of trees around, and it was in pretty flat geology or whatever. But it's getting more and more difficult. Anyway, you're talking about how that impact your father's bankruptcy had on you, and you sort of, for me, and I was planning on going into construction mainly because I just kind of liked that life, like just build stuff. You feel satisfied at the end of the day. You've accomplished this, and I imagine it's the same thing for farmers. You have to grow a crop, bring it in, you feel good. You've accomplished this. You feed people or provide, feed. Simple life, and, a happy life. And when I was young, and I got hit with a recession in the 90s, and basically I went from making really good money and having a team of people working for me to you couldn't even get any work, and wages plummeted from $50, $60 an hour to $6 an hour. Really, really tough times, and that made me decide to go back and start really studying the money cycle. But I got into tech because the internet was just taking off. And so I became a self-taught Microsoft consultant, Microsoft engineer, and then worked my way up to do work at the banks. And then I saw the internet bubble starting to form and started digging into stocks, thinking like everybody else at that time, it's like, oh, what's going on? We should buy these stocks. And I couldn't believe it. I thought I was like doing bad math when I first started looking at some of the balance sheets of these companies, because I was like, really, is that the market cap? Like when you multiply the number of shares by the share price, and you're looking at their revenues, and I was like, this makes no sense. And so I realized early on that this was, in my mind, especially for a lot of the .com and a lot of the B2B companies back then, they were supposed to be doing like web pages for people, and it was nothing that complicated. Yet they had like these ridiculous market caps. So anyway, I started picking stocks, doing well, playing the game, realizing that and preparing myself for the big short, which was I wanted to short the NASDAQ in 2000. and I wanted to. I started predicting that China and India were going to boom, and there was going to be this. We were coming out of a bear market then in commodities. 20-year bear market, right, since 1980, basically. And so I started studying everything I could on the commodity side as well. And I did really well for a few years, just trading my own capital, like multi-100% years, back to back to back. And then I went and I got introduced to Eric Sprott and joined Sprott Asset Management when it was like 13 people. And I got hired as a technical analyst and went on as a market strategist, and then became president of Sprott Inc. I started something called the Sprott Resource Corp, and it did private equity. It was publicly traded private equity. And I actually struggled to valuations were pretty high when that was running. So I never bought any gold and silver companies, but something I really wanted to do. I did, coal and phosphate and potash and oil and gas, and just, I was buying whatever's out of favor, very contrarian in my approach and just looking at the different cycles. Anyway, 2013.
How do you relate that cycle to today?
Well, yeah, that's what I was going to get to. I look at where we are today as being, it's very eerily similar with a tech bubble. And that's why I started following you, is I was looking at your charts, and your charts reminded me in my early days at Sprott. I loved getting Bridgewater reports, Ray Dalio's. For years and years, I read everything I could from Bridgewater and all their back issues and whatever. And I always loved their charts. And the charts that you always put out are just ones that, as I'm scrolling through Twitter, they just grab me. And I'm just like, yes. Like, when you see these big patterns, that's what I like to play, is like, commodities versus the S&P, mining stocks versus the S&P, all the different ratios, gold, silver ratio. And these big moves are what I care about, especially if you, I've always sort of been a guy who doesn't really like being in the office. And so and I was really attracted to guys like Jim Rogers and Mark Faber. Jim Rogers, how he just basically walked away. He actually hired George Soros, and George Soros was his trader. And Jim Rogers was the thinker behind the company, and made enough money that he just walked away at an early age and started traveling the world. Wrote a book called The Investment Biker. And then The Adventure Capitalist was another one. And so I was reading those books, and Mark Faber, who was saying, if you could just make one good trade every 10 years, but you have to get to a certain amount of capital before that, because I was trying to compound at a very high rate because I didn't have a lot of capital. But as you get more capital, you're like, something, I'm just going to park it in this big trade. I'm like loaded in on the commodity side and, the gold and the silver and whatever, just preparing for what I see as a big bull market. And back in the end of 2000, around Y2K, the reason I made the call that NASDAQ was in a bubble is I could see the excess capacity coming, right? Everybody, Michael Dell, John Chambers at Cisco, Bill Gates, all these guys were talking about, we're going to have 30% compounded growth for the next 10 years. And I'm looking at the stock valuations and saying, well, you better, because you need it to justify the stock prices today. And I don't believe you're going to have 30% compounded growth, because things like Cisco, and back then the fiber stocks were taking off. And everyone was like, we're going to need, the internet's going to be huge. And yeah, it's going to be huge, but who's going to make money? And is there really any money in this fiber optics given the build out that's happening? And we started seeing compression. And it was easy to see that the algorithms and the compression technology was going to collapse the need for bandwidth and collapse pricing. And then there was this huge front loading of purchase of equipment. Everyone was upgrading all their computers for Y2K, right? So, and I was working in the industry in the late 90s, and basically all the CTOs, right, the chief technical officers of the major banks, the government people, the major business, everybody was saying, we're upgrading now and we don't need to upgrade. We don't want to basically be buying anything other than laptops for the next 3 years. And I could just see this massive drop off coming, right? And all this new software had been bought in. Like, it was just crazy, the prices everyone was paying. And so I look today and I'm like, it's the same thing. Everyone's in a rush to get AI and build out this AI capacity, just like we saw with the cloud, right? And I'm like, nobody's going to make money with AI because they're going to build out so much capacity, and then Apple's going to give it away for free, and X is giving it away for basically for free, and Google's going to give it away for free. And if you don't give it away for free, somebody's going to buy a different phone or use a different social media app. So you're not going to be able to actually charge for the AI. And it's going to be the same thing as Microsoft destroyed the browser market. There used to be, you probably wouldn't remember, but around 2000, in the early days of the .com era and the internet bubble, people were paying up big dollars for companies like Netscape and Mosaic, and they're trying to judge who's going to win the browser war. And then Microsoft said, something, we're giving it away for free with our Windows. And then it just crushed the market. There was all of a sudden no one gave a shit about browsers. You can't compete, right? Anyway, that same sort of thing is what I see in tech right now, where there's this crazy valuation in tech, including things like Tesla. Although, obviously things could change with the robotics side of things, but as a car company, it's ridiculously overvalued. I think that almost nothing is more cyclical than chip prices, like computer chips. And we've seen crash after crash after crash over the decades in computer chip prices once there's excess capacity. And I think that that's what's going to happen in NVIDIA. We've already seen, Intel stepping up and saying they're going to spend all this money. And so I just see sort of this big decline in the NASDAQ tech stocks. And at the same time, we've been in a bear market for commodities, exactly like we've seen, leading up to 2000. And I expect we're going to see desperation in the U.S. to have interest rate cuts. They're going to have to manage the long end of the curve and try to bring down interest rates because they have to refinance their debt. They're going to have to quantitative ease because mathematically they can't afford interest rate hikes, right? But I sort of look at both, it's like bonds and stocks, real estate, all these things now are now correlated to Federal Reserve liquidity. And so when if the bond market sells off, the stock market's going to sell off. It used to be that they traded at an inverse. And I just see now it's just going to get more and more desperate for the U.S. because they can't let interest rates rise because it just increases the interest rate burden on the taxpayer in America. And so they have to force those rates down and they have to print. If you could sort of just think about trying to close both the budget deficit and the trade deficit in the USA, what are foreigners going to buy? If you put a gun to people's head and said, you must buy from us, right? The USA say, you must buy stuff from us. What are they going to buy? And I think it's energy intensive things more than anything, right? It's not going to be labor intensive, right? So, and I think that the things that are going to get bought are going to impact core PCI. And that's going to really piss people off even more. So I see at Crescat, you've got this model that says you got 16 factors that determine where we are in the economic cycle. And just give me sort of your big picture view of where you see things, because I think we're fairly aligned here, I believe, right?
Yeah, I do. Well, it's a lot of things to unpack, but I would say that model was created. I created the model. It's been a long time now, not quite a decade, but over 7 years. And the idea of the model was just to essentially look at things that have worked in the past to time the business cycle and hopefully have a way of identifying somewhere close to where we are in terms of risk as well as opportunities. And so model has been very useful, particularly when we went deeper into the yield curve issues of, when you get this large percentage of yield curve inversions, of which we had about a year and a half ago. And the coming out of that situation tends to be very bullish for gold relative to U.S. equities. And depending on the timing of this, going back to the 70s, you sort of have the beginning of of a very different macro regime where natural resources and other commodity related businesses tend to do very well relative to other companies. So this is why we have a bias towards that part of the market, of that part of the economy. Now, regarding the budget deficit and the fiscal deficit, or I should say, the fiscal and the trade balance deficit that we're currently running in the U.S. This goes back to what I think it's the core of at least my macro views right now, and I can't speak for the firm, but because there are differences in that part of the view. But to me, the U.S. is focused on those two things, and there's, I think Doge sort of is masking a much larger, impactful idea of suppressing rates, and I think that's happening in many fronts. You have just the pressure towards Jay Powell and lowering rates, and you have Basson talking about the 10-year and the 30-year yield and so forth, and trying to reduce rates by doing the right policies, of which has not been working well. As I don't think I need to mention that to folks, but that has been a challenging way of conducting markets recently. But we have to pay attention to what's maybe coming here. The Mar-a-Lago Accord, which to me is a fancy or word to talk about restructuring the debt and finding ways to lower rates in the long end. Although the long end doesn't really matter here, it's about 16% of the overall debt, anyways. So the biggest impact we're going to have in the U.S. debt is going to be on the 5-year lower in terms of duration of the debt, and so hence why the Fed and monetary policy, especially interest rate policy, is so relevant to this. So you sort of get it into a world where Bassett was doing an interview with Bloomberg reporter in Argentina, of which she asked questions about Powell and his policy stance and so forth. And he basically said don't worry about that part of it. I mean, we have enough tools in our toolkit of being the Treasury Secretary and so forth. And he referred to the buybacks of treasuries, and I just think that's so relevant because it creates so many different factors that could cause rates to fall substantially. So you have, what he talks about, the buybacks of treasuries,
this is quantitative easing.
Quantitative easing, just a separate name for quantitative easing, but it goes back to the revaluation of gold, of which he said he wouldn't do it. But how do you buy back, a lot of treasuries without revaluing gold? Like you actually have to revalue gold. So
this is something that I try to really, I'm going to keep on this subject of trying to explain this better, because, they love to use words like quantitative easing, and you call it buying back treasuries.
Yeah.
But really what it is paying your debts with money out of nowhere, right? You're creating capital out of nowhere to pay your debts.
Yeah.
And I like to look at it like the way I often talk about the system and trying to say, like, it's like those crime shows, follow the money. And so what is actually happening here is the Federal Reserve, when they decide to buy back treasuries, right? Mm-hmm. People even talk about the Federal Reserve as having a balance sheet. And I'm like, no, it's not a balance sheet. It doesn't balance. It's an asset ledger. It's what it is a historical record of monetizations. It's a historical record of printing money, of creating money out of nowhere. Mm-hmm. And so this idea of buying back, it's actually, in my mind, like you're just flat out creating money out of nowhere and saying, I'm taking the debts of the USA and I'm now saying to debt holders, here you go. Here's some freshly created digital money. Enjoy. And the difference between like why that's so important. I think people don't really get the importance of this, because one thing I talk about, and this comes up with Bitcoin as well, right? Like Bitcoin and crypto versus fiat. And I always talk about how what underpins the value of fiat, like I don't like cash. I haven't barely had any cash in 25 years. Okay. I prefer stocks. I prefer gold. I prefer silver. I prefer anything. I prefer real estate. I don't care about the short-term deflation blips, because I know there's going to be printing following any short-term deflation blips, right? And so, but I'm forced to buy dollars. I have to sell assets, whether they're stocks, gold, houses, property, whatever. I buy dollars every year, and I buy dollars to pay the government. The government makes me buy dollars, right? They price my assets and they say, you've made money, right? If I have, or you owe property tax, right? Like you could pretend you own land, but you're really leasing it from the government. If you don't pay the property taxes, which is like a lease payment, they'll take away your property. They'll sell it and give you the net, right? And so I sort of look at it like what underpins the value of fiat is the need is taxation. And the need for anyone that lives in a country or has assets in a country and wants to make money in a country, you have to price, if let's just say you're doing labor, you have to price your labor in the currency. And then when you pay taxes, it's like you're giving the government, it's like you're working for the government first. Let's just say your tax rate's 50%, like in Canada. 50% of my time goes to the government if I pay 50% tax. 50% of the labor that I put out there, whatever I do, it's like it goes to the government. And so if there's a debt and my taxes go to service the debt, it means that my labor goes to the holders of the debt, right? And so when you borrow money from foreign nations, what's happening is they've sent you these goods with the trade deficit, right? The US sends them dollars and says, we'll pay you later, right? Because it's been created, like the money flows into the US system through the budget deficit, right? Like a huge amount of the growth in capital is because of the budget deficit and fractional reserve banking. And so the money ends up flowing overseas and they sell goods, and a lot of the countries recycle that money back into stocks or back into bonds. And they just say, well, we'll park our savings in bonds, including the $3 trillion held overseas by US corporations that don't want to bring it back home, right? They'll just hold it in T-bills a lot of the time, or they'll invest in other assets. But at any rate, there's all this money that piles up because of the trade deficit. And anyway, when you decide that you're going to pay it back, not with labor, it's very penalizing on anyone who holds currency, bonds or stocks, right? You're diluting, you're creating more paper without creating goods or services, so the price of stuff rises. I'd like you to sort of comment on the reality of, like, I look at quantitative easing is one of the many broken promises that the U.S. has engaged in over the last, like since the start of the Federal Reserve. First, they said our currency is tied to gold, right? $20.67. And then they said, oh, well, wait, we can't do this. We created too much currency. Let's break the promise. It's no longer tied to gold for citizens. We'll keep it tied at 35 an ounce for foreigners. And then in 71, Nixon says, oh, sorry, we created too much money. Basically, but foreign holders, screw you. We're not going to give you our gold, right? And now this is the next big broken promise is, yes, you've got all this debt. We said we were going to pay you back with taxes, which means our citizens were going to work and provide goods and services to the economy. And then you could exchange those dollars basically for goods and services someday. But no, we're not doing that. Here you go. Take some digits, pound sand. And I see that as this big shift.
I think you're spot on. I think that these policies that are created to, I firmly believe we're seeing somewhat of the 1940s playbook, unfolding in front of us. I mean, the influencing Now, what are policies I think are underrated out there that could be extremely relevant is these changes of SLR and all
What
the
does that
tech.
stand for?
That's a good question. It's the technicality of the banks of allowing the banks to have treasuries actually being part of tier one assets,
Okay.
and
It's
therefore,
like a ratio. Is it some other kind of savings to loan ratio, probably?
yeah, and essentially what it does, it would just allow the banks to use that as a collateral or to be seen as a tier one asset. It would influence the banks to accumulate more of those government securities, and ultimately, be one of the buyers of last resort of the treasury market. And so it's critical. I mean, if when he talks about deregulation and all these things, this is all likely to be a big change on how banks will end up being large buyers of government securities. As part of, it has nothing to do with the buybacks of treasuries, but ultimately, if you revalue gold, in my view, maybe does the U.S. does have one, have in its if you think about incentives of allowing gold to run up as much as possible so they can revalue at a much higher value of price, and then ultimately increase the collateral value of their TGA account, the Treasury cash balance, that could be substantially higher. Right now, at current prices, we would get an increase on the TGA account of about 800, 900 billion. They already have 300 billion there. So that would be 1 point something trillion dollars, to use it to buy back or to do QE. This is where I think things could be leading towards. And it's just shocking to me a little bit that, there's not enough emphasis on the short end of the curve completely collapsing from here. I mean, I think that's almost it's not even a target; it's a measure. You have to do that, and
Yeah,
so
yeah.
that's your
I agree.
Doge. And
I agree.
so,
The Fed's going to step in and do whatever they have to do to bring down yields so they could lower the interest rate burden on the debt.
and even naturally, you have recession risk rising now, and if you take out policy making and just look at naturally, you're like, yeah, rates shouldn't be near 4%, right, on the 2 year. They probably should be cut in at least half. That's a huge move. I mean, imagine being levered up on that trade. I don't know how you see 2 year yields rising for the next 2 years. So if you're of that view, so now you have cap yields, right? And you said you want to talk about China. I mean, talk about a shift in view. We were always of the view that the dollar was the cleanest of all dirty shirts, and that was the right view 5-7 years ago. And now I'm seeing so many people come up with that same opinion with so much conviction after the fact, and I'm just not. I think it comes down to a research that I was looking at the other day, a few months ago. Interest payment to GDP of the U.S., which everybody knows is running about 4 to 5%. What the people don't talk about is no other country of the same, similar size of the U.S., even Europeans, are running a substantially lower interest payment to GDP, of which, studying than other reserve currency status that we had in the past. And you can have a lot of debt. I mean, that doesn't, it has implications and other things, but you can accumulate a lot more debt than the U.S. has currently. What you can't do is be paying 5% of GDP on interest. You have to lower that. And so if you understand that facts and you know that the U.S. is forced to lower rates much more than even Japan, that has to have an impact on currencies. In other words, Japanese yen rallying, euro rallying, all sorts of currencies are likely to rally because of this pressure that we have on the 2 year and the short end of the curve in the U.S. to then lower deficits in a big way. Forget about Doge. Just that alone it fixes the problem, or at least improves the problem of the exponential growth we're seeing on the debt front. And then you get to another question, which is the you're talking about the deficits on the trade balance. How do you fix that? I mean, Steve Moran has been talking about this chronic issue that we have on the trade balance and so forth. I mean, I don't know how you fix that with a strong dollar. Just don't know how you do that. I don't think you can. So if you're of the view that the dollar needs to be devalued, and Trump tweeted over the weekend again talking about no tariff barriers and how they've been doing manipulation on the currency side, and of which they have been devaluing their currency, and Trump wants to go after that, which means he wants to go after the dollar itself and reducing the valuation of the US dollar versus other currencies. So now you have a pressure on the dollar and a pressure on yields. What is the thing, let's think about opportunity now. What's the thing that emerging markets hate the most? Rising yields and strong dollar. It's like, and you're telling me those two things are going to be put on the side and somehow pressure lower, substantially lower. Then you look at the valuation of the dollar versus other currencies on the Fed trade weighted index, and it's one of the highest in history, as high as it was at the Plaza Accord. And everyone coming out and still, not too long ago, pounding the table on the dollar is the strongest of all currencies and so forth. And now you're seeing that shift of the view and causing the dollar to fall substantially versus the euro, versus the yen. I think that's the opportunity that no one is really seeing the relation. I mean, it's other countries doing very well, particularly emerging markets are gonna do extremely well in my view, because they haven't done well in a long time. They have been neglected for a very long time. You've got MSCI World and all sorts of indices that put marginally no weights on those economies. Their companies are extremely cheap relative to U.S. companies. Their currencies are extremely cheap. You can get, government bonds trading at double-digit interest rates today in those countries, and you can also have exposure to a foreign currency rather than the dollar. I don't understand how the world does not flow, back into those areas in the next even 3 years. I think that's going to be one of the biggest trades. Just like the miners, one of the biggest trades we're going to see here in the next few years.
And this is the same. Again, it goes back to the earlier conversation about what I saw in 2000. Mm-hmm. It was a pretty easy call to predict the emerging market rally. They're all, a lot of these countries are also tied to commodity stocks, right? Mm-hmm. Commodity stocks, commodities themselves. The currencies rally as commodities typically do well.
It's going to be a big trend. You can even do research within the emerging markets index, like the EEM from MSCI. Not a lot of people note this, but 70%, almost 80% of the weight in emerging markets ETF today is Asia. I don't know what people think here, but a major rebalancing within that could happen here too. And I think South America is just, look, I've been always skeptical of Brazil. And if there's a person who's been skeptical about it, I can raise my hand, because I've hated the corruption, hated the inflation problem, hated the focus on devaluing the currency to improve exports that have always damaged the stability of the currency, damaged inflows. And oh boy, I mean, there's so many things to talk about, the problems in emerging markets. I mean, I was recently involved in buying real estate there because I thought it was a great investment, really, talking about 3 months ago, and had my own lesson of how difficult it is to invest in those areas. I mean, unless you're buying an ETF, I mean, good luck opening a bank account. I'm Brazilian. It's hard enough for me to do it. Imagine for a foreigner who doesn't speak the language. People thinking I was a drug dealer. I think it's insane. It's just like, how do wealthy people invest large sums of money in those areas without being so difficult to transfer capital in those areas. And so you can kind of see why emerging markets are emerging markets in the first place. But at the same time, I'm not thinking that we're going to see structural changes in those countries. I just think there are times when capital flows into those markets, and I think we're getting close to one of those. And I would suspect that South America would be strongly linked to the US in terms of partnerships more than Asia, way more than Asia. And it amazes me that clearly, this is a contrarian view. I mean, how in the world is that a contrarian view? I mean, I can make the case all day long of why South America can benefit more than Asia in this environment, given this onshoring pressure we're seeing, and how places like Cambodia and others that have been benefiting supposedly from taking away some of the Chinese manufacturing businesses, and clearly are linked to China. It's almost, it's like factories in Mexico, they're backed by Chinese companies, clearly. And so I would suspect that South America is getting very close to some big changes, and in many fronts. I mean, we can talk about that even from an AI standpoint. How much energy is produced in those countries in excess to their own consumption, just being thrown away every year. They're not using it. Why don't we have data centers in Brazil? That's an easy fix. They have excess of electricity. Use it. We're blessed with rivers and all sorts of things. We got most of our energy.
Brazil has a lot of uranium as well, but it's under government control, the extraction.
Honestly, there's a lot of structural problems that you're referring to that will change as soon as they see the money. Yeah, that the government will change their view on this. And
I think that's what happens. Like, when you see these commodity price rises that I'm expecting, in how much they're going to benefit both Africa and South America, it leads to investment. It leads to capital flow, and then you get a revaluation.
Yeah, I think there's a pressure on South America, given the proximity, to not allow a lot of the ties with China. Africa, unfortunately, has got above and beyond that situation with loans and all sorts of things that have been very unfortunate in terms of the level of commitment of capital that has been already done from Chinese firms in Africa. South America has seen a lot of that too. It's not that it hasn't, but there's been a clear aversion to that level of capital in the last, call it 3 to 5 years. And I think it has to do a lot with the political landscape change in that region. Bolsonaro was a big part of that, with a more conservatism sort of agenda. First time we've seen a right party popularity in many decades. I have never seen in my lifetime the Brazilian economy seen a popularity on the right side of politics, and it's been my first time. I know it happened in the past, but I have not seen. And now we've seen this libertarian move with Milei and even El Salvador. And it's just, to me, it's a matter of time to see other leaders, right? In Chile, leaders in Peru. We're seeing, we're large investors in Bolivia. We see changes in Bolivia happening. Everything is changing from a political agenda standpoint of away from China in those areas, believe it or not. And I suspect that that's going to make the U.S. be very happy with those changes and more willing to negotiate deals with those countries. So
everything's cyclical at the end of the day. It's political cycles, economic cycles, cycles in nature, commodity cycles. I mean, you just go down the list. I'm actually working on a book right now that sort of takes you through resource investing and the cyclical nature of everything.
You're writing a book, or you're reading a book? Sorry, I didn't.
Writing a book.
Writing a book. Okay.
Yeah, I just finished one book. It's called The Energetic Investor.
Mm-hmm.
It's about mind, body, and finance.
Okay.
And I actually did a deep dive into biology. I wrote a model on how our cognition works.
Huh.
And it's right down to people used to look for the spotlight, like what makes your attention shift from one thing to the other. There's always been this thought that there was part of the brain that sort of controls the shift in focus. But what I've theorized based on my understanding of cellular biology, the plasma membrane, the mitochondria, these parts of our cells and the way our cells and neurons cluster is it's like a distributed computer system where, there's a fractal nature to the whole thing, similar to politics and economics. So you could picture a crowded room if you're at a conference. If, people are clustered, and if one group starts laughing or getting excited, making lots of noise, the other groups quiet down and look, well, what are they talking about? Yeah. That's what happens in our head. You've got a cluster of neuron activity when part of your brain's working on something and it's like, oh, eureka, I discovered something. It gets the attention. It increases amplitude and frequency, production of ATP. It starts broadcasting, and other areas of your body will connect in. So it's instead of having a top-down control.
How do you stimulate that?
Pardon?
How do you? Sorry to cut you off, but how do you stimulate that change in your brain that causes those moments of the discovery or something?
Well, that's one of the things I get into in my book, because it's at the core. You look at the different types of fuel in your brain, right? You have glucose. You could run on glucose. You could run on ketones, and you could run on lactate. And people used to always think of lactic acid and, what you get from your muscles as being, it's almost like generally thought of as being negative, but it's actually a premium fuel for your brain. And it's so you can think at very high rates and react in the moment. Like if you think about being in the flow state and doing some sports, right? You think about how all the details you're picking up, like when you're playing tennis, when you're absolutely in the zone and focused, right? And you're using all your muscles and you get warmed up, then you're actually, your brain's optimized. And this is sort of, it's like it's counterintuitive. You think you're tired and that, but if you take a break, you don't need food. Sometimes you just need to breathe and go hit, if you go hit the gym, you come back, you feel fresh and your mind's recharged. You've replenished the ions literally the ions and the atoms and the molecules of your brain cells are replenished from exercise.
I find it amazing how many times I have my best ideas in the middle of a long run. It's crazy. I have to stop and take notes.
That's exactly why. And so anyway, the idea is these clusters, you start working on problems, right? Everything has to be connected. When you bring in data, right? You're reading your Bloomberg, you're reading newspapers, and then in the background, it could even be when you're sleeping, your subconscious, your neurons start working on these different problems, right? You work on different problems in your life, and then sometimes they surface, different things trigger it. And you're like, oh, I need to worry about this, or I need to worry about that. And I'm all about getting into the flow state, getting into that zone. I'm sure, when you're distracted and you're trying to focus in on and play an important match in tennis, it's not going to work out. You can't be thinking about, you see a guy like Nadal, doing his little thing and he wipes his, and he bothers him that when the bottles, if the labels aren't all turned right, it's because that he'll find that he's getting ready to serve and he keeps noticing one of these bottles is turned, and it takes him out of supreme focus, right? Because if you want to have your best serve possible, or your best you're trying to receive, you want to focus on, you're using your hair on your arms to pick up the wind, all these things subtly below the surface. Your body is like a giant supercomputer. And so you're trying to pick up all this data so that you can, and you could predict, the best players, they could predict early on where the opponent's going to serve before the opponent's even served. There's like slight signals. You sometimes you can't even put your finger on it, but somehow that the guy does this little thing with his hand as he's serving, and he's going to the left or the right, and I look at it like the same thing. If you're deciding you're going to dig in and focus on the markets, you can't have other distractions in your life. You got to be like, okay, it's time for me to work. get into my mode. I'm going to go through my routine, right? Your pre-market, like if, back when I was a trader, I have a pre-market routine. I'm going to read this. I used to read all the top categories on Bloomberg, get myself all focused. Then I'd be like, okay, now I got a sense, and I've read all my chat groups, and I like, I have the CNBC maybe, and I could try to feel the energy, Well, what are people thinking today? Where's the market going to go? And then I try to anticipate it. That's back when I was a short-term trader, right? And I'd be like, okay, it's going to be a top day. I can feel the euphoria. I can see it, This is a blow-off day. The technicals were extended. And then it's like, once we go negative, I'm like, aha, right? Crushed. Emotions are crushed today. We didn't rally on good news. Get short as hell, right? Get short as hell, because that's it. If you can't rally on good news, just like if the stocks don't go down on bad news, it's time to load up, right? And it's just, and so this is part of what my book gets into. I think it's the only book that actually, people have written books on the psychology of money, like Morgan Housel. My book's the only one I've ever seen that deals with the biopsychology, like the actual psych. Like everyone says, don't buy, you want to, avoid greed and fear, right? Don't panic, sell, take profits when, people say it, but they don't know how to train someone to do it. It's like, don't be a choker, right? In tennis, it's like, okay, what do you got to do early on? You got to get your breath right. You got to focus. You got to be prepared. You got to prepare for those times so that you can rally and you can pull up energy at the important times to overcome and win that point, right? And not be deflated. Anyway, Trump, his policies are like stepping on a nail, for the world. So everybody's focused on him because it's painful, right? He does something, it shoots pain, and then everybody's focused on it. And so what we have to do is let's not focus on what he's doing today, because we know it's unsustainable. We know that they're not going to hold these policies in place. We have to do the analysis and dig beneath and say, okay, well, what's going to happen? And when I start looking at things like that, I'm like, well, China, if you try to force the trade deficit closed with China, they're going to say, okay, well, fine, we'll buy soybeans, we'll buy cattle, we'll buy chickens, we'll buy corn, we'll buy LNG, we'll buy oil, we'll buy, I don't know. I mean, if the U.S. ever started producing uranium again, they'll say, sure, we'll take some uranium, we'll take some copper, we'll take stuff, because the cost overall, it's not that bad of a trade, right? It's not that bad of a trade for them. But for them to say we're going to, if the U.S. actually thinks they're going to be able to make iPhones cheaper in the U.S. and sell them to China someday, it's ludicrous. It's absurd. I think most people don't understand how ridiculous this system is, how bankers in the banking system is allowed to create money out of thin air, just like the Federal Reserve in a way with the fractional reserve system, own bonds and collect this massive amount of interest and a huge return on capital with almost no risk. Is everyone sort of forced to look at the debt and go, how are we going to deal with this debt problem? They're going to say, when the Fed buys back 4.7 trillion, if they own 4.8 trillion treasuries right now, why don't they just write them off? Like, if the Fed's bought them, the debt has been paid with cash, they could just cancel those bonds. Like, look up the QSIP numbers and cancel them. They don't exist. Like, if I lent myself $1 billion and tried to claim I had $1 billion in cash and $1 billion in debt, you'd be like, you're just playing numbers games.
Yeah, I mean, I think the answer is you would completely kill the dollar, obviously, but
so they don't do it because it would kill the dollar, because they have to maintain this illusion.
Yeah, I agree, but honestly, you're not wrong. Isn't that funny? I mean,
Let's just take it to an extreme. Let's just say they buy another 5 trillion over the next 5 years. I mean, the 5 trillion basically that they own is equivalent to what the entire debt was in like 1996.
Yeah.
Like, they basically wiped out the entire debt in a matter of months. They wiped out the entire debt from the history to 1996, 1995. And just go, here you go. Here's some digits. Right?
Yeah.
And I'm just saying, in practical terms, if the Fed's going to start selling those bonds back into the market, it's going to put pressure on yields. It's going to have all these problems. You say, like, whether it comes back to the market from the Fed or from the Treasury with a reissuance, it doesn't really matter. Like, I just wonder, like, tell me, where do you think the dollar goes if, like, there's reality? They've done it. They printed it. They own it. They own a debt to themselves. Those bonds, the interest that's charged on it, gets collected by the Federal Reserve, and they credit it back to the government.
Yeah.
So why not print another 10 trillion and lower the debt? I mean, you say the dollar's going to fall, but don't they want that anyway?
They
Don't
do
we
want
need
that.
the dollar to fall?
Oh, I don't think that's an idea that I think it's inevitable, really. It's like, don't they want inflation to run hotter than historical standards? Yeah.
I think they have to inflate the debt away. They have to make GDP. GDP needs to rise higher, quicker than the debt. How does that happen?
Can they say that publicly? No. So it's I mean, another thing that is in line with all this is if they want to revalue gold much higher to allow them to then buy back or do QE, whatever, buy back treasuries, instead of letting the market do that,
Can you just explain that again? Like,
Sure.
I keep hearing about people talking about the gold revaluation thing, and it's just an accounting entry. I don't know why they need to revalue gold to buy back treasuries, because they've already shown that they do it whenever they want to.
Well, this thesis is not mine. This thesis came out
I'm just trying to understand it.
Zoltan Polzer was an important economist, as you probably know him, and he's was part of the whole restructuring rules of the banks back after the global financial crisis, and was working for Citigroup for a long time, left Citigroup, started his own firm, and he's sharing research. He's very good friends with Bassin. And he's the first person I heard that started talking about the potential revaluation of gold and how would that, sort of look like. And more recently, you've seen this sort of conversation on, the sovereign wealth funds that the government was going to create. Then the question was, are they going to be buying gold in that? Will they revalue gold and so forth? That was just all noise. And then how do you allow the government? It comes down to, how do you allow the government to have a bigger influence? The talking about the Treasury, not the Fed, a bigger influence in its policies of reducing rates, if that's their main focus, relative to the Fed. And one way that has been proposed is that if you increase the value of gold in the balance sheet, would then increase the collateral value of that asset, that would allow the Treasury cash account to be increased by the amount that has been increased by the collateral increase. So let's say if we go to current value of gold, it would increase the collateral value for about $800 billion, almost $1 trillion. So that ultimately would also add that same amount to the TGA account, allowing the government to spend another $800 billion. So that's why the revaluation is absolutely critical. And some crypto people have been now understanding that it's important for gold to be revalued to allow the government to even buy $100 billion of crypto, right? That's sort of the only, not the only, but the main path being presented here. And the idea is not really even the crypto space. The crypto is sort of, again, potentially masking the big idea, which is by revaluing gold, you allow the government to then buy back treasuries. Now, the question that I wanted to pose, that I think it's, to me, what's happening right now, with gold prices rising as much as they have been rising, is if the government has an incentive to increase the value of gold, to then increase their amount of cash that they can use to do things, why not increase the value of gold themselves by purchasing it themselves? And it wouldn't shock me at all if the move we're seeing right now is being caused by the U.S. actually accumulating gold. I mean, we've seen imports of gold from. I know it sounds crazy, but I don't think
it sounds crazy. I mean,
I don't think Bessen's largest position was gold prior to coming to this. I mean, it wouldn't be crazy at all if they are the ones
I would
driving.
expect if the U.S. is going to eventually buy gold again, I would expect that trade to be front run by insiders.
I really
Like
think
every single frickin' trade,
yeah.
every big trade, every big government policy that's going to affect markets, I expect to be front run by insiders.
Yeah.
You know,
I really think that's the case here.
do you have a hedge fund?
We do, yes.
Do you long short?
We have a global macro fund and a long short and a precious metals fund. The global macro does everything on different asset classes. The long short does anything on equities, and then the precious metals does things on mostly.
Let's chat again. I've enjoyed chatting with you. If you want to chat again sometime, we'll chat again. I'd love to talk about the hedge fund strategy, and I did want to go into more on your gold fund. So just tell me, if I wanted to buy your gold fund, how do I buy it? Do I have to open an account with you, or do you have anything traded? They're not publicly traded, right? Your gold fund?
No, it's a private fund, and investors would have to communicate with us, and we do a $500,000 minimum investment in the funds, and it's for accredited investors and qualified purchasers.
I really appreciate all the time, and we could do this again sometimes. I really enjoyed chatting with you.
Thanks for having me, Kevin. Appreciate the conversation. Hopefully we can have another one soon. But thanks for having me.
Awesome.